Okay, so if you've been waiting for a clear signal that, investment banking and the capital markets are properly back on their feet, well, Morgan Stanley's Q3 2025 results pretty much scream it from the rooftops. We're jumping into a whole stack of sources today, painting a picture of a, frankly, financial giant hitting record net revenues, and this is key generating some really outstanding returns on its capital.
That really is the headline story, isn't it? And we want to get beyond just those top-line numbers. I mean, $18.2 billion in net revs, $2 in EPS, they sound great, but how do they actually pull it off? Our mission today is to unpack the engines behind this performance: institutional securities, wealth management, and investment management.
And maybe the one number to keep in mind, the one that kind of ties it all together, is that 23.5% return on average tangible common equity, ROTCE,
Yeah.
which, for anyone keeping school at home, is a huge jump from 17.5% just a year ago. That's quite a leap.
It's a massive leap. And that ROTCE figure, that's like the result, right?
Yeah.
But the strategy, the thing driving it, well, the CEO put it best. It's the integrated firm strategy, delivering across the board, globally. And this deep dive, I think, will really show how that integration is fueling that impressive 23.5% return.
Okay, let's get into that integrated strength then. Starting maybe firm-wide, looking at the consolidated picture, Q3 this year versus Q3 last year. Net revenues, you mentioned $18.2 billion. That's up 18% year over year. And pre-tax income soared 43% to over $6 billion. I mean, that's just explosive growth at the top.
It is, but what's maybe even more insightful, looking at management discipline, isn't just the revenue jump itself. It's how efficiently they manage it. They got real leverage from that growth. Their firm expense efficiency ratio, basically expenses as a chunk of revenue, it improves significantly. Dropped from 72% a year back down to 67% this quarter.
Right, so making a lot more money and spending a smaller slice of each dollar earned to actually make it. That's textbook operating leverage. And that's
Yeah.
got to be a huge piece of how they hit that really standout 23.5% ROTCE.
Exactly right. This wasn't just growth happening to them. It feels like very disciplined, managed growth. And you see that reflected on the balance sheet, too. Total assets grew, sure, up 8% to over $1.36 trillion. But look at loans, up 16% to $277 billion. Deposits up 11%. They're expanding, but it seems, controlled.
Okay, now let's dig into a detail that, for me anyway, almost jumps off the page. It feels like a massive statement of confidence. It's this. The provision for credit losses for the entire firm was zero. Zip. For the quarter.
Yeah, the zero is, yeah, it's pretty astonishing. A year ago, Q3 2024, they put aside $79 million anticipating potential loan losses. This quarter, nothing. It suggests management feels incredibly comfortable about the current economic outlook and, crucially, about the quality of that $277 billion loan book they've been growing so quickly.
I have to push on that a little bit, though. Zero sounds amazing, right? No expected losses. But growing loans that fast, 16% up, and assuming zero future losses, does that feel aggressive? I mean, is there a risk there maybe under provisioning? If that improved scenario they mentioned takes a turn, it signals huge optimism, but maybe not a ton of caution.
That's a really fair challenge, and it's the core tension, I think, in these numbers. Management is clearly betting that the upside from lending and deploying capital right now outweighs that perceived risk. They think the environment is that good. We should definitely hold on to that thought as we look at institutional securities, because that zero provision story, well, it pops up again there.
Okay, good transition. Let's talk institutional securities, or IS. This is the more cyclical part, right? The classic Wall Street stuff, investment banking, sales, and trading. And yeah, it looked really strong. Net revenues hit $8.5 billion, up 25% year over year. Pre-tax income leaped, 67%, giving them a pre-tax margin of 37%, pretty profitable.
Yeah, if the whole firm is about integration, IS is kind of the sprinter, right? Really capitalizing on the market conditions. Investment banking revenues, specifically, up 44% year over year, over $2.1 billion. This really confirms that the deal-making drought we saw for a while, it seems well and truly over.
And it's interesting when you break down how that investment banking revenue jumped. Advisory was up 25%, more completed M&A deals. That makes sense. But the capital raising side, the underwriting, that's where you really see the market thawing.
Totally. The sources talk about a more constructive market environment, and the numbers back it up. Equity underwriting revenue just shot up 80% year over year. More IPOs, more convertible offerings, and fixed income underwriting was also strong, up 39%. Companies are finding it easier and more attractive to borrow again. The capital markets are definitely open for business.
And the trading side was humming too. Equity trading revenues climbed 35%. What caught my eye was the mention of record results in prime brokerage. Maybe unpack that for us.
Yeah.
What's prime brokerage and why is a record there significant?
Sure. So prime brokerage. Think of it as the suite of services banks, like Morgan Stanley, offer to their really big, sophisticated clients, mainly hedge funds. It includes things like lending them securities to short, clearing their trades, providing financing, holding their assets. When prime brokerage hits a record, it tells you a couple of things. One, hedge funds are very active, trading a lot, taking positions. And two, they trust Morgan Stanley with their core operations and, huge amounts of capital. It's kind of a barometer for institutional activity and confidence.
Got it. Makes sense. Fixed income trading was a bit more muted compared to equities, but still solid, up 8%, driven mostly by credit and commodities, especially in structured deals, though it looks like foreign exchange was a bit weaker, pulling the overall number down slightly.
Right. And just looping back to that risk point we discussed earlier, the provision for credit losses within IS was just $1 million. Tiny. Down from $68 million a year ago. And the report explicitly says this drop is mainly thanks to the greater benefit of improved macroeconomic scenario. So the part of the bank dealing directly with corporate credit risk, they basically saw almost zero new risk emerging in Q3.
Okay, so if IS is the cyclical sprinter enjoying the good weather, then wealth management, WM, that's the steady marathon runner, right? The high margin anchor. Let's shift to that engine of consistency.
Exactly. WM turned in $8.2 billion in net revenue, up 13% year over year. And look at the margin, 30.3% pre-tax. Very stable, very profitable. And this is where that integrated firm idea really clicks, isn't it? IS does the deals, generates the underwriting fees, maybe creates some wealth events. WM is there to gather and manage those client assets long term.
And they're clearly a massive magnet for those assets. Total client assets hit a staggering $7.054 trillion. That's up 18% in a year. But the really key operational metric here, I think, is net new assets, NNA, the new money coming in the door.
That's the one. NNA represents fresh inflows. And they pulled in $81 billion in NNA just in this quarter. That's up 27% from the same quarter last year. That's very strong. And critically, a lot of that inflow tends to go into the more, let's say, sticky fee-based accounts.
Right, which generates that reliable revenue. A fee-based client assets, the ones earning fees, regardless of how much the client trades, reached $2.65 trillion. And they saw over $41 billion flow into those fee-based setups this quarter alone. That builds a really solid foundation of recurring income.
And you see that flowing through the revenue lines. Asset management fees were up 12%, basically driven by having more assets under management and those positive fee-based flows. But net interest income, NII, was also up 12%. So
Yeah.
they're earning more from the difference between what they pay on deposits and earn on loans within wealth management too, helped by balance sheet changes and just more lending overall.
Speaking of lending, that's where a chunk of that firm-wide loan growth we talked about earlier actually lives. WM loans hit almost $174 billion. Mostly split, it looks like, between lending against securities portfolios and residential real estate lending. So it's not just advice, it's becoming a full-service banking relationship for these clients.
Yeah, definitely. Just one little footnote here on operations. The number of people in their stock plan services dipped slightly, but the sources are clear this was expected. It was due to the previously announced disposition of the EMEA stock plan business. So a deliberate strategic move, not a sign of weakness in that area.
Okay, that makes sense. A structural change. All right, let's hit the third leg of the stool. Investment management, IM, and maybe wrap in the global picture too. IM revenues were $1.7 billion, up 13% year over year, so solid growth there as well.
Yeah, but the really big story in IM this quarter is the turnaround in flows. Assets under management, AUM, grew to $1.8 trillion, which is impressive. But the crucial number is total net flows. Positive $41.3 billion flowed in this quarter. You absolutely have to remember that just the quarter before, Q2, they had negative flows of $16.5 billion going out. So this is a massive reversal.
Wow, okay, from minus $16.5 billion to plus $41.3 billion in one quarter. That's huge. And if we strip out the more volatile stuff, the long-term net flows were $16.5 billion. That's up 126% compared to last year's Q3. Where did that long-term money predominantly go?
Looks like the vast majority went into alternatives and customized solutions. That category alone pulled in $14.2 billion of the $16.5 billion in long-term flows. It really shows that institutional clients, and probably very high net worth individuals too, are actively seeking out those complex, non-traditional investment strategies right now.
And that demand for alternatives seems to have paid off nicely in another area, performance-based income. That jumped 65% year over year, driven, the report says, by higher carried interest. We hear that term carried interest a lot, especially with private equity. What does that big jump tell us?
So carried interest, or carry, is basically Morgan Stanley's share of the profits from the private equity funds or other alternative investments they manage for clients. They only get this carry if the fund performs well, hitting certain return hurdles. So a 65% jump means their underlying investments, likely in those alternative strategies, had a really, really good quarter. They realized significant gains, hit their performance targets, and triggered those carry payments. It's a sign their investment picks are working. Though it's worth noting, as the report does, that this success also meant higher compensation costs in the IM segment. Performance pays, literally.
Right, got to pay the managers who deliver. Okay, zooming out globally for a second, where's the money being made? Americas is still the core, obviously, over $13.6 billion in revenue. But Asia looked like the real growth engine this quarter, up 31% to $2.6 billion. That seems like strong execution of that global integrated firm idea. EMEA also grew, up 6%.
Yeah, Asia was definitely a standout. All right, finally, let's touch on capital. This is maybe less exciting for some, but it's crucial for regulators and, long-term stability. And the picture here is very strong. Their main capital measure, the Standardized Common Equity Tier 1 ratio, CET1, is sitting at a healthy 15.2%.
And just quickly, CET1, that's the core measure of a bank's ability to absorb losses, right? The higher is generally seen as safer. And they also scored a big win on the regulatory front that actually gives them more flexibility with that capital.
Yep, that's right. They successfully got their stress capital buffer, the SCB, reduced. It went from 5.1% down to 4.3%, effective from October 1st. Now, that might sound technical, but it's a pretty big deal. The SCB is basically extra capital regulators make banks hold, based on how they perform in stress tests, simulating a severe recession. Getting it lowered by 80 basis points means the regulators think Morgan Stanley's risk management and overall profile have improved significantly. They don't need to tie up quite as much capital just sitting there as a buffer.
Which, in turn, frees up that capital. Could be used for more lending, maybe, or returning to shareholders. Which brings us neatly to shareholder value.
Exactly. And they were active there, too. They bought back $1.1 billion of their own stock during the quarter, a sign they think it's good value. Plus, they declared a $1 quarterly dividend per share, and all this financial strength and capital management fed through to the book value per share, which climbed to $62.98.
Okay, so let's try and pull this all together. What's the main takeaway here? The Q3 results seem to show success happening at the same time across very different parts of the bank. You've got that cyclical investment banking part firing again because the market's better, but you've also got that steady, high-margin wealth management machine just consistently pulling in assets and fees.
Precisely. I think the data really shows a bank that didn't just sort of ride the wave of an improving market, the rebound in deals, rising asset values. They actively leveraged it. They did it through really tight cost control. Remember that 67% efficiency ratio, that synergy, IS feeding WM, both benefiting from market conditions but also managed efficiently. That is the integrated firm strategy playing out, and that's what's driving that explosive ROTCE number.
Yeah, it's a picture of discipline meeting opportunity. But let's end, as we often do, with something for you, the listener, to maybe chew on. We kept coming back to that provision for credit losses. Consolidated, it was zero. In Institutional Securities, basically zero. Vanished. Yet at the same time, total loans across the whole firm grew 16% year over year. They're lending more.
So here's the question. With the loan book expanding that significantly, what does that near-zero provision tell you about how Morgan Stanley sees future economic risk right now? Are they calling the credit cycle perfectly? Or are they perhaps taking a more optimistic, maybe even slightly riskier stance than some others might be, given that growth, that tension between growth ambition and perceived risk? That feels like the most interesting underlying story here.
An excellent point to ponder. Until our next deep dive.